The inevitable in some ways has happened. The government has disclosed that it will be borrowing a lot more this year to take care of the expenditures that have come in the wake of the COVID-19 spread and the economic impact of that. The government today disclosed that it will borrow 12 lakh crore for the current fiscal. That's 12 lakh crore compared to the budgeted 7.8 lakh crore. The math works out to a nearly 50% increase on the budgeted borrowings. Now that 12 lakh crore, one could be tempted to do a little bit of a back of the envelope calculation to suggest what it would be as a percentage and what it would imply as for the fiscal deficit. But remember, there is a great deal of uncertainty on what the GDP numbers for FY21 will look like. There is also some uncertainty on what the GDP numbers for FY20 will settle at. So I'm not going to tell you what the implications of this are on the fiscal deficit number. At least I'm going to desist from that. Let me tell you what we do know. Which is the borrowing calendar for the rest of the first half of this year. So from here on, you will see the government borrowing 30,000 crore in each weekly auction. The maturity profile of the issuances looks something like this. They will borrow 30,000 crore via 2-year bonds, 1.2 lakh crore via 5-year bonds, 1.8 lakh crore via 10-year bonds, 1.1 lakh crore via 14-year bonds, 70,000 crore via 30-year bonds, 50,000 crore via 40-year bonds, and another 40,000 crore via floating rate bonds. But if you broadly look at it, it does look like the borrowings are a little bit skewed towards the higher end of the yield curve or the longer end of the yield curve. So you will see bond yields on the longer end start to move up. Now, in fact, just on Friday, you had seen the 10-year bond yield come down to below 6% for the first time since 2009. Well, that's not going to last, because when yields open on Monday, you will certainly see a jump unless there is some announcement from the Reserve Bank of India telling us how they intend to step in to support the government borrowings. Now, here, there are two parts. Now, one implication being drawn from this borrowing calendar being put out is that the government does intend to go via the market. The fact that they put out this borrowing calendar probably gives you a large hint that they intend to go via the bond markets. But it doesn't tell you what the Reserve Bank of India may do indirectly via open market operations. Perhaps it does suggest that direct monetization, where the government is selling these bonds to the RBI, is not something they're immediately thinking of. But honestly, you cannot rule that out, because it will entirely depend on the market reaction from here on. Now, what are economists and the few people we managed to speak to saying on this? Aditi Nayyar of ICRA says that the upward revision was inevitable. Given the extent of revenue loss and the expenditure increase. She goes on to say that borrowings are likely to mean a higher yield on the 10-year and also some of the other longer dated securities. We spoke to Pankaj Pathak of Quantum Asset Management. Again, he said that the yield curve on the longer tenor bonds will be steepening and moving upwards from here on, whereas shorter tenor bonds may be supported by the RBI and some other domestic institutions which hold this paper. He went on to say that this was expected, but it will still have a slightly negative effect on the bond markets, since the expectation was that the RBI may start monetizing the government debt. So just to summarize, we have seen the government raise its full-year borrowing target to 12 lakh crore. That's over a 50% jump from its budgeted number. And we do seem to have an indication that the government intends to go via the market right now, but we don't have information as to what the RBI is going to do to support it. They will certainly do something to support it. If they are not buying bonds directly from the government, they will announce large-scale open market operations. It would be my guess.